Hi dear traders and investors, I'm glad to present to you a red hot market review prepared by analytics and forecasters FxCo portal. Here we go. Today is December 19 and we continue the march of central banks meeting, focused on USD JPY Yuri Tolin. On the eve of tomorrow's Bank of Japan meeting, the yen is strengthening against its main competitors, the euro, the pound, and the dollar, after it spent the past week in a range against the dollar, still undecided about the direction of further movement. And last week's controversial macro data from Japan also contributed to this. The data suggests that Japan's industrial sector remains under pressure due to rising inflation, declining orders, and the global economic crisis. Thus, the Tankan Sentiment Index of Japan's largest enterprises for the manufacturing sector fell from 8 points to 7 points in the fourth quarter. At the same time, Japan's trade balance deficit in November reached 2.027 trillion yen instead of the expected 1.680 trillion yen due to stronger growth in imports, which in turn rose due to increased energy and fuel supplies. The volume of exports from Japan declined, including against the backdrop of lower demand for Japan's goods in China due to serious quarantine restrictions. The only thing that pleases is the Japanese service sector. The value of sentiment index of Japan's largest enterprises in the fourth quarter for the services sector increased from 14 points to 19 points, exceeding the projected 17 points. The recovery of domestic demand and tourism also contributed to the growth in the service sector. Ahead of tomorrow's meeting, the results of a survey conducted by Reuters are of interest, according to which almost half of the surveyed economists believe that the Bank of Japan can curtail its super loose monetary policy in 2023. At the same time, Bloomberg reported last week, citing the latest data from the Japanese Bankers Association, that the country's banks could suffer losses on their government bonds in the amount of 1.1 trillion if the Bank of Japan loosens its grip on 10-year bond yields. Since 2013, it has been declaring its commitment to achieving the 2% inflation target as soon as possible by conducting an ultra-soft monetary policy. In October, Japan's annual core consumer price index rose 3.6%, the strongest gain in 40 years. Therefore, there's talk in the markets that the Bank of Japan may change its yield curve control policy and allow higher rates when Kuroda's term ends next April. In the meantime, Bank of Japan Governor Kuroda dismisses the possibility of a rate hike in the short term. Previously, he repeatedly promised to maintain the current level of stimulus and inflation reached 2% on a stable basis. Thus, the main scenario for the Bank of Japan tomorrow is to keep the current monetary policy unchanged. And even if next year the Bank of Japan still decides to raise interest rates and change its YCC policy, interest rates in Japan will remain significantly below the rates of other major world central banks, which will make the yen vulnerable against its competitors in the foreign exchange market. However, this does not exclude the possibility of periods of its sharp strengthening, especially if market participants remember it as a traditional defensive asset. Today, as we noted above, the yen is strengthening, including against the US dollar. As of writing, USD JPY was trading below 136.00, near 135.90, moving towards long-term support at 135.20. Its breakdown, and especially the breakdown of the long-term support level 132.80, significantly increases the risk of breaking the bullish trend, which so far remains in the long-term bull market zone. Note that decision on the rate of the Bank of Japan will be published tomorrow at 03 GMT, and the press conference will begin at 6. In its course, Kuroda will comment on the bank's monetary policy and the decision. As Kuroda has repeatedly stated earlier, it's appropriate for Japan to patiently continue the current loose monetary policy. He will probably say the same thing this time. We got a trading tips for gold by Andrei Shevchenko. The gold market was bearish last Friday, perhaps because many long positions were closed due to it being the weekend. But this morning, prices bounced back by 50%, which opens new levels for short positions in the market. Considering that there is a three-wave pattern A, B, and C, in which wave A represents the selling pressure in gold, traders should enter the market by taking short positions from the 50% Fibonacci retracement level. Set stop loss at 1822, then exit aboard the breakdown of 1773 and 1765, and maybe lower, 1640. This trading idea is based on the price action and stop hunting methods. Santa Claus rally could push Euro-dollar pair higher. Confident talk with Marek Petkovic. Markets are rising in expectations when investors are skeptical about the Fed's intention to raise the cost of borrowing to 5.25% and overestimate the prospect of an ECB deposit rate hike. Euro-dollar quotes should rise, at least in the short term, in the fact that the major currency pair could not permanently consolidate above 1.07 is an unfortunate misunderstanding. The Santa Claus rally in the US stock market is ahead, which means that Euro fans should prepare for a new attack. Who was more successful at the last central bank meetings in 2022, Jerome Powell or Christine Lagarde? It would seem that the retreat of Euro-dollar from semi-annual highs and the fall of US stock indices indicate that the third chairman was more effective. However, CME derivatives have not changed their expectation for the federal funds rate ceiling. They remained at 4.88% even despite the higher FOMC forecasts. The reason, most likely, is that the Fed has lowered its estimates on GDP and unemployment. It expects a recession and reduction in domestic demand, which will reduce inflation. As a result, the central bank will not need to raise the cost of borrowing as high as it expects. Lagarde, on the contrary, succeeded with the high-profile phrases that the ECB intends to play long and is ready to continue to take the same broad steps as in December and beyond to convince investors that the deposit rate peak is higher than they expected. As a result, the indicator rose to 3.21%. The counteraction of the differential with its US counterpart is a bullish sign for Euro-dollar pair. Moreover, European business activity in December, according to the flash estimate, exceeded the forecasts, while the US fell short of them. There is still a difference in the monetary policy of the Fed and the ECB in the strength of the US and Eurozone economies, but its narrowing which allows Euro-USD to lick the wounds suffered in 2022 in count on the development of an upward trend in 2023. The fall of the US stock indices, frightened by a series of disappointing statistics, put a spoke in the wheels of the bulls, but at the end of the year, a Christmas rally usually happens with the S&P 500. Investors are full of hope for the next year and are enthusiastically buying shares. If history repeats itself at the very finish of 2022, the euro may rise to 1.08, 1.09. Another thing is that there will be more evidence of an approaching US recession in the first quarter. Weak data will pull US stock indices down, which will create conditions for euro-dollar to fall towards 1.04, 1.05. Subsequently, the pair will rise to 1.1, 1.12 by the end of 2023. How to trade dollar index tells Alexandros Yolantis. The dollar index is trading above the upper wage boundary. Price is showing signs of strength, signs of reversal. Bulls need to start a sequence of higher highs and higher lows in order for this to be a confirmed reversal. The combination of the Bulls RSI divergence and the exit from the downward sloping wedge pattern is favorable to bulls. A rejection here could lead the index towards 102.70. That's all for today. Have a nice trading day. See you next time.